Okay, you can start, Christine.
Okay. Well, first of all, thank everyone for taking the time to attend this morning and thinking that I might have a relevant view to share. I mean, simply speaking, it's really not too late. I've got such strong conviction that oil and gas is going higher that I actually recently contacted my dad, who I trade for a little bit, and I had him give me, more money because I felt like there was just going to be greater upside here, at least for the next year, if not for the next few years. Okay, so, disclaimer, everything that I'm going to say today, it's not necessarily investment advice. It's really just my own personal opinion. I'm not a financial advisor. I'm not a portfolio manager. I don't hold any licenses. I'm just an individual investor. I have worked 2 years in the oil and gas industry, both on the service side as well as, in the operator space. I've worked domestically and internationally. And, I've got some business acumen rolled in there. I've worked as a drilling engineer as well as a economic advisor and a portfolio advisor for oil and gas operators. But as all things, there are no warranties in investing. At any given time, something could go wrong. I mean, if there's a major market sell-off, it takes everything down with it. It isn't going to matter, just like during the March crash, it didn't matter what you were invested in, everything crashed. So I'm going to use the XOP to kind of demonstrate where I bought, because the XOP, it's really a more diversified oil and gas ETF. It kind of couples in the equipment and services side along with the oil and gas integrated space, whereas the XLE index, I mean, you're mostly just buying Exxon and Chevron. I mean, they totally dominate that curve. So, as we can see here on the XOP, everyone knows about the March crash that we experienced. When that happened and oil was trading at, negative 20-something a barrel on the spot price, I actually dumped everything that I held in equities and in mutual funds, and I poured into oil and gas companies that I felt like could survive the Armageddon. So, down here in March, I was buying Hess in the 20s, Chevron in the 50s. I bought OVV below $4. I was buying Neighbors at $25 a share. And then, we started to, rebound. In June, we had a peak. And then at that point in time, I found out in retrospect that BlackRock actually sold huge chunks of their positions, and it caused another crash. But this was kind of also when we were getting that COVID second wave, and again, all the pandemonium, we started going for a double dip. So when I saw this double dip coming, in my mind, I was like, man, I need to raise more cash because I know we're going to spike again. I actually sold my home because that was the quickest way that I could raise cash, because I owned my house outright. And I had that house sold and all the money in the market by the end of October. On November 9th, which is actually my birthday, that was when the Pfizer vaccine, I guess, came out as being approved. And on November 9th, that morning I woke up like $250,000 richer. So since November, we've been in, we've continued to climb. As everyone knows, we had the February freeze, which resulted in some confusion around the supply-demand situation because a lot of refineries were shut in, so storage was building, and when storage builds, it causes the price of oil to pull back. So this year, like early in March, we kind of had a peak, and then we pulled back, and we've been somewhat rage trading until this week. this week we've started to recover again, and I believe that this recovery trend is going to continue, you know, through the end of the year. So this is the WTI spot oil price, you know, just over the last year. I mean, you know, going from 20-something dollars to, you know, now 52-week highs. I mean, it's really been prolific. So, you know, last year, you know, even though we've been building out biofuel capacity and wind and solar and whatnot, I mean, oil and gas, you know, it continues to be the dominant, you know, the dominant energy source worldwide. Even with all of the COVID lockdowns and people not driving as much and planes not flying as much, the industry, the demand didn't pull back as much as what people thought. I mean, you know, they thought that consumption was going to halve, and it really just went down about 20%, which really speaks to how dependent we are on oil and gas, you know, just for our basic needs and for transporting, you know, food and you know, providing energy to our houses and you know, all the industrial usages that were required to maintain, even though the rest of the world was shut down. So, and this is just kind of a breakdown for 2020 of how fossil fuels were used. I mean, only 31% of all the fossil fuels last year, you know, went to transportation. There's other blocks that are basically unaffected by the COVID lockdowns. Year over year, the U.S. Energy Information Administration, they actually put out an international energy outlook, which kind of gives the projections for the different fuels over the coming decades. You know, as you can imagine, you know, these projections don't change very much year over year. You know, but based off of 2019 projections, we were still going to be increasing our needs for you know, petroleum, natural gas, you know, through 2020 or 2050. You know, even though renewables are ramping up, you know, at magnitudes, you know, our basic need for oil and gas, it's not going away. And then, you know, there's all this talk that, you know, we're not going to need much oil and gas simply because EVs are going to, you know, take over in the transportation sector. But, you know, you also got to rationally think about this. You know, no government administration can force the American consumer to buy a new EV next year. I mean, it's just not going to happen. You know, not everyone can afford an EV. B, we don't have the infrastructure in place to charge all the EVs. Most people don't have, if you live in an older home, you probably don't even have the capacity without changing out your electricity panel in order to put an EV plug in your garage. You know, 50% of people are renters, and there's not EV charging stations when they return back to their apartment each night. I mean, there's just all these things that are gonna you know, kind of maintain a steady growth of EV over time. But at the same time, you know, as EV is growing, population is growing, more people are buying cars. It just really doesn't eat into what our demands are going to be for oil and gas for the transportation space, you know, for years and years to come, which is all good news for oil and gas because pretty much the price is driven by supply and demand. Even if we look at all of the current available technology and what it would take to, like let's just say governments threw all the money they wanted to push this Green New Deal transition through as quickly as possible. You know, you're looking at decades to build out the infrastructure. So pretty much our oil and gas dependency is going to maintain flat or grow for the next, you know, 20 or 30 years. And it's only going to be after 20 or 30 years when that dependency starts to decline. And you can see here, this is actually from the 2020, or sorry, yeah, from the 2020 Energy Outlook, which was distributed in February of this year. And, and it goes to show that, even with the most rapid, extreme global conversion to other energy, energy fuel stocks, by 2050, which is still 30 years away, I mean, we're still needing like a significant amount of oil and gas. I kind of also wanted to point to what's been going on in the oil and gas space over the previous 10 years, because it creates a further upside that I don't think the market has fully realized yet. So, if you look back to 2009 to 2015, WTI was really trading in this $80 to $110 window, which is a great window for oil and gas prices. I mean, oil and gas companies are highly profitable between $80 and $110 a barrel. But at that same time was the rise of U.S. shale, and U.S. shale brought, tons and tons of barrels, millions of barrels into the market, and it threatened the OPEC position, in the global market. And so there actually was a number of price wars that kicked off in 2015, and those price wars had more or less put the, as well as the additional supply, had put oil trading, between $40 and $70 a barrel. And at the same time, oil was trading between $40 and $70 a barrel. Companies, they stopped reinvesting so much, and oil and gas supply, it actually requires this treadmill of reinvestment. If you're not reinvesting, drilling new wells, over time, the field production actually declines. So intuitively, if you think about it, if companies haven't been spending a lot of money over the past few years, that's going to create a potential supply squeeze in the future. And then also, OPEC countries, they're heavily reliant on their revenues from oil and gas sales in order to fund, their nations. Saudi Arabia, it's estimated from the U.S. monetary, or the International Monetary Fund, they actually need oil prices of about, $75 a barrel Brent in order for them to just simply even balance their budgets. Russia, it's one of the lowest cost producers. They're probably making money between $35 and $40 a barrel. But everyone else, I mean, they really need much higher prices, which is the reason why now we're seeing OPEC is restraining their supply, because, I mean, they have to. I mean, they have to achieve higher prices, otherwise, they're going to have fiscal problems. So, and I'm going to apologize for the grainy slide here. This was the best I could do on a screen grab. I didn't have access to the original slide, but this forecast is actually quite lovely. So, you can see the drop in supply during the COVID crash, and then the return. You can see what the pre-COVID, demand path was, and Goldman Sachs. I mean, these are their projections. They're actually showing that the window between supply and demand is narrowing, because essentially, our demand is growing faster now than the return of barrels back into the market. Goldman Sachs, they are expecting that over the next 6 months, that oil is actually going to reach $80 a barrel with further risk to the upside. So there's also hints that a super cycle might be possible. And again, this goes back to money not being reinvested in the industry since 2015. We had multiple years there. Actually, at the end of 2019, oil companies were actually starting to ramp up their hiring because they saw that in 2020 they were going to have to ramp up their activity in order to arrest the potential, years of decline in the, coming. But then in 2020, when COVID hit, that put all their plans into chaos. They actually ratcheted down their production even more as they were shutting in wells and laying people off. And so it's just exasperated this longer term problem. And it's only going to take a few more months before consensus shifts to the demand side. And that's when we're going to see oil prices explode. Goldman, they see it. That's why they're talking about $80 a barrel. The EIA, they give out weekly inventory data on the supply and demand. And as this year has gone along, they have been revising their inventories lower and lower because they're seeing that the supply is, again, it's not coming back into the market as quickly as what they thought, and the demand is just increasing. So historically, there's an inverse correlation between inventory and oil prices, and you can see, it's flagged here, kind of where our inventories were, at this moment, and if this supply squeeze continues, you can see as the supply continues to go down, and our storage gets less and less, below our needed requirements, for consumption going forward, the price is just going to continue to creep up. This is the WTI strip prices, and month over month, and you can see that for this past year, they've also been increasing the strip prices, higher and higher. All the time, I have people asking me, I don't understand, or they're saying, hey, I don't understand what's going on with the stock. Oil prices are $65 a barrel. Last time oil prices were $65 a barrel. This stock was 4 times higher. What's going on? And my response is always the same. The strip price right now doesn't look the same as when the strip price was the last time the spot price was $65 a barrel. So you really have to think about what the strip price looks like going forward. Right now, the strip price is in backwardation, which basically means that the market strip price right now, it's based on this assumption that there's not going to be a supply squeeze. The strip price keeps expecting more and more barrels to come into the market. And what I think is going to happen is over the coming months, the strip price is actually going to start to flatten out, if not go higher. And that's going to just completely shift the price targets that all these analysts have for these stocks, because right now we're not even fairly traded at today's strip prices. So what happens when the strip price goes, from $50 in outward years to $70 in outward years? I mean, it's just going to be, beautiful for this sector. Just this past week, all of a sudden we're seeing people placing bets on $100 a barrel oil. So, you can look at my presentation, you could just do a quick Google search and read the full article. But yeah, I mean, we've got options traders now buying $100 calls on December Brent for the end of the year. So, we kind of have to think about this investment, paradigm and where we're at. Last year in March and up through, November, I think we were in that stealth and awareness phase. When the vaccines came into play, that's when all of a sudden, the world and the markets, kind of relaxed, and they said, okay, demand's coming back. Everyone now is starting to talk about oil and gas in the media. So I kind of feel like we're entering into the mania stage when it comes to oil and gas investing. But if we see the spot price, move up to $80 or $100 a barrel, I mean, that's when we're going to get into this new paradigm regime. And this curve, I mean, it's really just a a cartoon. You know, I've posted this online before, and people are like trying to correlate the dips with certain months, and you know, I don't mean for anyone to read too much into this curve, because I mean, who knows? I mean, the new paradigm might actually flatten out before it drops. So, you know, as everyone knows, you know, there's various ways to play the oil and gas markets depending on your risk profile. You know, you can go with the majors or the integrated companies, producers. I mean, there's a plethora in there, from small caps to bigger companies. I feel like there is a lot of opportunity right now in the oil field services and equipment sector, because activity, I mean, it basically was left for dead, put on life support last year. And now, as we look at this potential supply squeeze and activity needing to ramp up, the oil field service sector, it's really going to ramp up. I mean, I think quarter over quarter, you're going to see better and better revenues, better and better earnings per share. Actually, when I look at an oil field service company to buy, I always check the job boards and I see how many jobs they have posted, because I feel like that's a leading indicator. A lot of the oil field services, their balance sheets look like crap. So you have to look for other indicators, you know, versus the oil and gas producers. You know, you can look at the book value of their reserves. There's going to be a good catalyst based off of book values for reserves for oil and gas producers at the end of the year, because at the end of every year, when the SEC looks at the value of a company's reserves, they calculate those reserves based off of the average oil price from the previous year. So last year, since the oil price was horrible, the book values at the beginning of this year are based off of really inferior oil prices. At this next year, the oil prices are going to have been much higher for the entire year. So almost every company who hasn't sold off a significant portion of assets, their book value at the end of the year is going to be calculated as being a much, much higher number than where it is right now. Also, like, you know, in the US, we're currently producing about 10% less volume than we were pre-COVID. So that also makes the pipelines a potential really good buy here, because, you know, where they are now, they're based off of moving less molecules. So as the supply, you know, returns to the market, they're going to be moving more and more molecules through their lines. They're going to be receiving higher and higher revenues. So this is just kind of a quick look at, you know, some general ETFs. Many of them, I mean, they're still 20 to 30% less than where they traded in January 2020. But also remember that January 2020 was at the end of multiple price wars. So you really have to look back much further to see where these ETFs could potentially go. And much of them are 50% cheaper than where they were in 2018. You know, and this is just a quick summary of the rig count versus the frac crew count. So I don't know, some people in here, they've probably heard about DUCs. Those are drilled uncompleted wells that are basically sitting out in inventory that can be escalated to come online. So you can use rig count as a leading indicator of barrels returning to the market, because the rig count is actually you drilling wells. But the more important metric, it's really the frac crew count, because those are wells that are actually being completed, and those can include wells that were drilled, you know, years ago and are sitting in inventory and are just waiting to come online. So, you know, in 2019, the frac crew count was about 400. You know, today it's 200. You know, like, where does the frac crew count need to be in order to increase production? I mean, in my mind, it probably needs to be, you know, over 250 or 350 just to increase the production point forward. So again, those are service companies that are just going to continue to ramp up, continue to rehire. The rig count right now, which is about 450. I mean, from a decline of 800 rigs early in 2020, I mean, you can just see the upside there. Some of these drilling companies, I mean, they're really going to start to ratchet up from where they're trading at current levels, because their sales are just, and revenues are going to continue to ratchet up. So, make sure you double check some of these numbers, because I actually created this slide, late last night, and I didn't fully go back and sense check it. But when I was flipping through some of my charts, while Frank was speaking, I kind of started to question some of these year-to-dates. But if you just look at the performance over the previous year of some of these oil and gas sector funds, I mean, their runs have just been truly prolific. But again, like, compare them to where they were 3 years ago, and it's easy to see that you could actually just grab some of these sector ETFs. I mean, with pretty low risk and without doing a lot of due diligence, and really have some easy money here for the next year or two. A lot of these ETFs actually they pay great dividends. The Pickens Core Midstream ETF, which is pipeline companies, it's paying almost a 9% dividend right now. And potentially it's going to pop another 25% just to get back to where it was trading 3 years ago. So definitely have a look at some of these ETF charts. I mean, they're incredibly juicy. So kind of my playbook, is I hold a significant core position of undervalued stocks that haven't even achieved their current fair market value. But again, I'm also believing that those fair market values are going to be upgraded, as the year goes along. I'm looking for companies that have low or manageable debt, or even if they do have a lot of debt, companies that don't have a lot of debt obligations here in the next couple of years. I want companies that are actually generating enough free cash flow right now so that they can at least maintain, if not grow, their production point forward. There are some companies that are so debt laden that they really can't afford to complete enough wells to keep their production from falling quarter over quarter. And this past quarterly report, it's not obvious that that's an issue. But I think that when Q2 comes in, there's going to be a few surprises, because I think there's going to be a number of companies that we see are struggling to maintain their existing production with their current cash spend. So that will require them to spend more money in the latter half of the year, and it could potentially slow down their momentum. I mean, honestly, I think that buying oil and gas stocks right now, it's almost like fishing in a barrel. I mean, you have to be very unlucky and not doing any level of diligence at all in order to pick a player that's not going to do well. I'm also very opportunistic. So recently in March, when we saw this pullback in a lot of stocks, I was looking for companies that pulled back the most from their March peak. And when I saw that they had bottomed out, I actually opened a lot of new positions, primarily in oilfield services and equipment stocks. A lot of them had double bottoms, so I felt really good about adding there. Some companies trade at a higher premium, so I don't necessarily like to buy their options. But when I can find options that are trading at the money or in the money, I try to buy options that are 3 to 6 months out, just for like a quick win, and I'll sell them on a pop, or I definitely try to exit them before 30 days so that I don't get the decay. But I mean, that strategy has been working really well for me. So a lot of people also say, well, what about all this global warming? Are there opportunities outside of fossil fuels, simply because they don't feel good about investing in fossil fuels? You also need to understand that the Paris Agreement, it's got some issues right now. I mean, they're trying to convince the U.S. and Europe and these different countries, they're trying to convince their people in order to approve all this spending. But at the meantime, China, like that one country, its greenhouse gas emissions are greater than the rest of the developed countries combined. Like it actually makes no sense to me that we want to spend trillions and trillions of dollars here in the US to reduce our greenhouse gas footprint when we could probably spend $1 trillion in China and reduce theirs by half. But you can also look into, everyone wants lower producers or lower pollution. There's not one person who works in oil and gas who thinks that pollution is good or it's acceptable. Everyone in oil and gas, they're always looking at better ways to modernize their equipment and modernize the ways that they're completing and delivering oil and gas in order to be more ESG, or an environmentally friendly. So as we look at this energy transition, and people who own Exxon, they're probably already clued in on Exxon and they've got some carbon capture ideas on the horizon that other companies are also starting to look into. So if you can identify some carbon capture opportunities that reduce emissions in the oil and gas space, again, when you think about how much the world consumes oil and gas, carbon capture and an emissions reduction, they're really the low-hanging fruit for oil, for being environmentally friendly and for reducing emissions and productions. A couple years ago, the marine sector, they actually required that, all these big ships reduce their emissions. And there were pretty much two ways, for these marine tankers to go about that. And it was to either convert their diesel engines to LNG powered engines, or to implement, scrubbing technology. Well, the scrubbing technology was overwhelmingly less of a cost burden. So that's what almost everyone did. Unfortunately, I was late to that opportunity. So when I identified it, like most of the companies that produce that technology, they'd already run up, by multiples. And so I didn't want to buy, 2 years late to the game. But but if you're looking for, if you're like someone who loves technology, when you think about that space, anyone who's coming up with emissions reductions technologies for aviation, that'll be a much cheaper way for that field to reduce their emissions versus trying to convert over to biofuels, which are limited in supply. And let's face it, corn is going up. The price of lumber is going up. That means the price of biofuels is going up as well. When the cement production globally actually produces 7 to 8% of all the emissions. So if a company comes out with a way in order to reduce the emissions in cement, that company's going to end up being a huge winner. And another reason to be incredibly bullish on oil and gas is it actually takes a lot of oil and gas just to build out wind infrastructure, solar infrastructure, more nuclear, all of the battery storage and the EVs, they're dependent on rare minerals. And mining, like all of the mining functions, also require a lot of oil and gas, in their everyday operations just to get the jobs done. You got to be careful where you play because, there's going to be stumbling blocks. recently here, April 30th, 2001, an article comes out stating 20% of EV owners in California have now switched back. And you got to think that the people who are the first movers on the EV space in California, I mean, those are probably the most, woke, wanting to be EV friendly of all the potential purchasers out there. And for 20% of them to later trade in their EV and go back to a internal combustion engine, I mean, it really says something about the performance of those cars relative to, to an internal combustion engine. I mean, again, right now we don't have all the charging stations. People, they don't want to drive an EV if they have to go a long way. You don't want to be driving an EV if you get stranded in a traffic jam, for hours. Like even for everyone in Houston, I mean, you can think about what happens during a hurricane evacuation. I mean, would you really want to be sitting in a highway during a hurricane evacuation, hoping that your EV is going to make it until the traffic lets up, or it's going to get you where you want to go? I mean, there's going to be a lot of people that are going to push back hard on converting from an internal combustion engine car, a gas-powered car, to an EV. And so just some of the resources that I use whenever I'm, identifying stocks. Before I enter anything, I like to look at Fintel. I've got a subscription there. I think it costs $250 to $300 a year. It lets me look at a summary of all the institutions who are buying and selling, the insider sales and trades. It also tends to put like a chart of the put call spreads on there. So if you see that the puts are being bought up quicker and quicker than the calls, that's usually a bearish symbol. So you might want to kind of risk off there, or maybe not play there. Each week, I'm getting the inventory data from EIA. I listen to the Platts Capital Crude Weekly podcast, which comes out, I want to say every weekend. Primary Vision Network, that's actually an excellent resource. There's a guy he's probably my age, like in his early 40s in New York, and I think he used to work for Morgan Stanley, if I remember right. But he puts out these incredibly detailed YouTube forecasts. There's 3 of them that are released each week on a regular schedule, and then he will also do kind of one-off podcasts with various people in the industry where they talk about what they're seeing. But I listen to his podcast every week. I mean, it's great. He really breaks down all of the different inventories and the flows. So if you want to go hard in the oil and gas space, I mean, knowing, listening to him and kind of seeing what's going on in the world and seeing what's going on with shipping and supply and demand, I mean, it's just incredibly valuable, and it makes you comfortable in making these bets like I've done. Sankey Research, he's also out of New York. He does a free newsletter. Energy Perspective Group, I actually subscribe also to Dan, because he puts out his cash flow models for a number of companies, which I think is really great because you can play around with the models. I mean, it's worth $250 a year just to have someone build these models for you so that you can play with the oil price and kind of see what the value of some of these companies will be if the spot prices move higher. If you like Twitter, there's an incredible amount of information that you can get for free on Twitter. Just search the hashtag EFT, which I think it stands for Energy Finance Twitter, or OOTT, which honestly I'm not sure what it stands for, but everyone tags it. Or you could just even put like any given stock that you're interested in. You can put a $ with the stock symbol and search Twitter for that. I mean, you will find so we just had all these earnings reports. I mean, I follow, a dozen people on Twitter who are detailed oil and gas analysts, and they will actually go through the 10Qs and the 10Ks and everything else, and they will break down exactly what they're seeing in those reports and the information that they feed back. I mean, it's so valuable. Like, for instance, I was recently thinking about taking a position in NOG. And then one of these guys, he kind of did his analysis of what the report was telling us. And I read through his analysis and I kind of compared it to the report. And I thought to myself, wow, you know, I'm so glad I didn't, I actually didn't pull the trigger on NOG. Like his analysis confirmed my hesitation. And then on StockTwits, it's similar to Twitter for stocks. So really the only thing that's discussed on there is stocks. People will subscribe to a certain stock symbol or to various people who are on there. I actually just made my account in June of last year, and I've already got over 1,500 people who follow me. So I will, if I'm entering a new stock, I will usually announce that I'm entering it so that people who follow me, if they want to know what I'm trading, they, you know, they'll use that for a lead. Other people that I follow in the space, I kind of use them the same way. Like if they flag a stock, it'll at least make me go look at the chart. There is a lot of mania on there because the average person really doesn't know what they're doing or talking about. But the mania can also be a good thing, because if everyone is excited about a stock, I mean, you can really kind of get a feel for what the sentiment might be for that stock, you know, going forward. So my profile name, you know, is She Drills. You know, everything I share on there is public, so it's easy to see. But you know, even if you don't want to trade oil and gas stocks, if you are just interested in any given stock, you know, you can actually use that to find leads, you know, on any given stock in the sector. So I know, you know, everyone who's on this call, I mean, they're probably a little bit like me, you know, like I love my stock investing, but none of my friends and family really want to listen to me talk about it. So I've got to find my virtual online community so that I can really nerd out and talk about my various positions. Because, you know, the average person on the street, you know, they just don't find that to be interesting conversation. So I had to go find my people, more or less. And I guess now I will turn it over for any questions.
Okay. Christine, I've got some questions for you.
Okay, I'm ready.
Okay, and it's actually from one of our members here, and he's actually got quite a few questions for you if you've got the time. And if anybody else wants to ask a question to Christine, just type it in where you have the question mark icon. So anyways, here, one question is, do you think the new strains of COVID, for example, what's going now in India and is spreading, do you think it will continue to put a resistance on the oil market and affect the growth of the oil market?
I think that any slack that is created in India, I think it's going to end up getting picked up by other countries. Right now, they're actually using a lot of, so during the March crash, when we had all this additional supply and nowhere to put it because demand was falling off, a lot of shipping tanks were actually just parking their ship offshore and using their ship for storage. So kind of what's happening right now in India is you know, we're starting to see some of this storage kind of, you know, increase, but you know, but it looks like you know, I mean, again, this is a global commodity, so you know, if one area doesn't need that fuel and another area has the opportunity to buy it at yesterday's price or whatever, you know, typically that ship can just, you know, sell wherever it's needed. So, you know, it does create fear in the market, but like when you look at kind of what's, you know, what's played out over the last year, you know, like everything is more or less resolving itself. And I just have a hard time believing that people in general will accept any further extreme lockdowns. So first of all, economies can't take it. If we continue to keep, people locked down and not working and not producing and not out of work, it creates further problems, because people who've been out of work for too long, they get to where they don't want to return to work. And we're kind of seeing that now, in the U.S. jobs report. People aren't incentivized to go back to work, and they're not, so, there's issues there. But, again, like when you look at some potential supply demand shocks in the near term, so long as you believe that we're going to resolve that issue over the next year, like for instance, India, if everyone's shipping them additional vaccines, eventually they're going to get their COVID under control, and they'll get back to, they'll get back to increasing their demand.
Okay.
And I hope I don't have to show a screen or anything, because for some reason my mouse has stopped working while I've been presenting.
Yeah.
So I really can't take over.
You don't have to show a screen. Like I said, for some reason my Chromebook, I'm viewing the presentation fine, but on my iPad it cratered. So I don't know what's going on. Okay. Another question here is you had mentioned a little bit about the service companies for oil and gas. Do you have any companies or maybe which companies that the areas that they specialize in that you think would be good to invest?
So, like kind of what Frank said, like when people ask me, hey, I want to just buy one or two stocks, in my mind, it's really hard to pick the stock that's going to be the supreme winner or whatnot. I think you're better off buying an ETF. You can buy the OIH, which is basically an ETF that's levered to oil, oil field services and equipment. And that would be a better way for you to trade that if you don't want to closely monitor any particular, company point forward. So that way you kind of get the spread, you get the upside and the stability of being in the Schlumbergers and the Bakers and the Halliburtons. But the smaller companies, which tend to, the smaller companies have been more deeply hurt by the pullback. So it's like if Chevron, for instance, or Schlumberger, if their stock price was cut in half, if you look at their small cap equivalent, a lot of those companies last year went down by 80%. And so now, going forward, Chevron might only be, and I haven't looked at the Chevron charts, I'm just kind of talking off the top of my head, but Chevron might only be down 10%, from its recent highs, whereas an oil field service company might be down 30%. So that's why I feel like there's much more gains to be had there in the service sector if you're looking for higher multiples. But again, you can just buy the service sector index, which is OIH, and if you look at the chart, you can see the potential.
Okay. Next question here. Related to that, on your 11th slide on oil demand and crude oil production, you mentioned that Goldman Sachs expected the biggest jump in oil demand ever. Pardon me. One of the members questions how reliable Goldman Sachs really is when it comes to forecasting, because he reminds us that back in 2014, Goldman forecasted $200 a barrel oil price. So, and then the price just tanked afterwards. So,
yeah, For me, it's more of a indicator of sentiment. So if you've got big banks like Goldman Sachs and Morgan Stanley coming out, JP Morgan Chase, when they start talking about higher and higher oil prices, ears perk up. So I mean, you really can't take their number and use it as a rule. But you can take the fact that they're pointing to much higher prices as a change in sentiment shift. And that might be also why we're seeing this money, moving more and more into these, into the oil and gas sector.
Right.
I mean, I feel like $100 is possible next year, but again, that's just my opinion. Everyone's got an opinion, only time will tell.
Right. See, another question here. He wants to know, how did you know that BlackRock sold in June? This was, I guess, earlier in your presentation.
Yeah, so Fintel, which I subscribe to, any given stock, you can go, and like I said, I wish my mouse wasn't frozen up, because if it was working, I'd switch over to Fintel and show you. But I can look at the institutional activity, and so when insiders trade, they have to report that within a few days of their trade. And when institutions trade, I want to say they have to make the report 30 days, usually 30 days after they trade. But basically, when I look back at what happened in June when the prices fell, I can see everyone who sold in June. And BlackRock has strong positions in almost all oil and gas companies worth owning. So if BlackRock owns 5 or 10% of the stock, and if they even sell 1% of what they of that, it creates a price shock in the sector, because so many shares are being sold, at any given time. But you can get that for any stock on Fintel, and if you, depending on the size of your portfolio and, how much you have at risk, I like, for me, $250 a year to be able to look at that information, it's worth it. And then they have a number of screeners that you can use. Like, you can actually have emails sent to you through Fintel to alert you whenever certain actions occur. So it's like, if someone, like for instance, if an insider buys a ton of shares of any given stock, you could have Fintel actually sending you an email alert that says that, because usually insiders buying and selling, those are also good indicators usually of where the insiders believe that the stock price is going to go forward.
Okay, excellent. That's a wonderful tip. The next couple of questions, I guess, deal with renewables and electric vehicles. And I've got a thought with regards to the current environment and technology and the cancel culture, and everything seems to be topsy-turvy. If one is into conspiracy theories, with the switch to EVs, electric vehicles, we all know about their limited range, and you had mentioned that. What do you do when Houston has to evacuate it for a hurricane? But if just think about this: what better way to control a population than to control their mobility? Because with internal combustion engines, there's virtually no limit on one's mobility. But with an electric vehicle, you're pretty much tied to a certain location.
Yeah, but there's also some safety issues that are starting to flag. So, if you watch the news recently, you probably heard about that EV, the Tesla that wrecked in the Woodlands, and yes, the driver and his friend were killed. But for me, if a car that's on autonomous driving or autopilot wrecks, I mean, that's not like a big red flag for me. What the big red flag was that it took like over 30,000 barrels or gallons of water to put out the fire, and the fire department actually had to call Tesla for guidance on what to do, because these lithium batteries, they burn incredibly hot, and you can't use water to put them out. You know, you have to use other types of extinguishing methods, and most fire departments nationwide are not equipped with the resources to put out an EV fire. So you know, right now on the road, I think only 1% of our cars are EVs. But as EVs continue to roll out and more of these fires start occurring in various people's communities, I have a hard time thinking that people are going to want to own a car that's hard to put out, you know, when it's on fire. And you know, one detail that I haven't even looked at yet was how wild do those fires get once they occur? And I think about those things because my dad actually is a retired you know, firefighter. So I mean, there's huge safety issues there if these fires can't be extinguished, and if the resources aren't available with local fire departments to put out these fires. You know, again, like everyone knows that all of our municipal budgets are constrained. How are fire departments even supposed to go out and get all this equipment if they don't have the money to, you know, in order to put these fires out? I mean, there are problems that are not being discussed that are very alarming.
Okay. Yes. In fact, one of the let me see here. Yeah. In fact, one of our attendees is a member of a fire department, and he states that basically what they try to do is just to keep the fire from spreading, as opposed to extinguishing it. So, yeah, that's an excellent point. Yeah. Okay. With regards to, again, with renewables.
Well, and actually, so along those lines, I also will point out, so what happens when one of these fires occur in a tunnel or under a bridge? I mean, just think about it. What happens if one of these fires occur in a parking garage? It's going to be catastrophic. And why people aren't talking about this on the news when they're talking about how great EVs are, it's shocking to me.
Yeah. You know, that's an excellent point. What about if your car is parked in your garage and your garage is attached to your house? How many people actually have a fire alarm in their garage? Ever thought about that?
Lithium fires, I mean, they burn incredibly hot. So, I mean, just like any chemical fire does. It's
right. Yeah.
Problem
Okay.
we're talking about, you know, it's and you know, I mean, you know, clearly our administration wants everyone to run out and buy an EV, and the unintended consequences, I feel like, are just going to be catastrophic.
Right. So, with regards to renewables, since they're expected to grow quite a bit, are you aware or anticipating any stocks that specialize in any companies that specialize in renewables?
So earlier this year, I actually had invested in a number of biofuel companies and wind and solar infrastructure related companies. And I ended up getting out because that entire sector had worked its way into a bubble. And now there's been a huge pullback, and these earnings reports are starting to come in, and I wouldn't buy here. I would wait and watch and see what what the sector is doing. There's also, so there's a company, the ticker is AMTX, that I was in earlier this year. It's a biofuel company, and a lot of big banks have very juicy price targets hung on that based off of potential growth projections. And I was in it for a while. I think I made 30,000 or something on it, but then like I said, when it started when it started pulling down, I got out. Yesterday, the stock was down over 20%. Basically, when some of these reports came out about this company, people started looking at some of the acquisitions that the company had been making in order to grow its business over the last year. And almost all the acquisitions were self-dealing. So people within the organization owned companies that didn't look like they had a lot of assets or actually delivered any revenues, and yet the company had used investment money to buy these companies, deliver big payouts to people on their management team, and I just, long story short, I'm just not comfortable with the space right now. Again, I feel like it's in a bubble. There will be companies that do very well, and there will be other companies that are traded on fumes, but quarter over quarter, as the earnings reports come out and they're not delivering, those companies that have been overhyped, you're going to be in free fall, in my opinion. So I would just be careful there. I don't own a single clean energy stock at the moment.
Yeah. So I guess in summary, would you say that renewables aren't really in competition with the oil and gas sector?
I mean, not at the moment. I think they will be. I just think that there's a shakeout occurring right now in that space. So I would wait for it to level off, and then maybe you can jump back in. But if you look at the charts for most of the biofuel stocks and the clean energy infrastructure plays, they don't look healthy right now. And I do have about 8 of these stocks kind of on a watch list, and I look at their performance every day, on my charts, and I just kind of really laugh and shake my head. So,
right. Frank would like to know here if you could provide an overview of the incremental crude supply demand balance.
Christine, this was from yesterday. I think you went over that with me, but I thought it might be helpful. In the $90–100 million supply demand balance, what's really in the Ghawar oil field in Saudi Arabia? Where is Iran in this whole thing? Because both of those are a swing of 5 to 10 million. You had some answers to that. I thought they'd be helpful to this group.
Yeah, I mean, I'm not really able to talk about that in detail right now. Now, I know there's a lot of people that are worried about, Iran, these barrels coming back into the market. A lot of insiders believe that the barrels are already being absorbed by China in the black market. So when it becomes legal for them to sell them on the open market, it's not really, a lot of insiders believe that when those barrels return to the market, it's not really going to impact supply demand too much, because they're kind of already filling a space. It's just filling an invisible space because they're, being black market, traded to China. But so long as OPEC continues to do what they've been doing for the last year, and I don't see any reason why they wouldn't, because it's working, oil prices are going to go up. So basically, OPEC, they have been restraining their supply. Look, every month, at the beginning of the month, they have an OPEC meeting, and they reevaluate what they're seeing globally in terms of supply and demand. And I believe it was a month ago, they put out a 3-month forecast. And so when they recently revisited that 1 month in, they kept to their existing forecast. So people, traders kind of know what supply is expected over the next 2 months. And then after that, you know, we'll continue to see. But it's, I mean, when you look at what OPEC has been doing over the past year, you know, it's clear that they want to continue to restrain the supply so that they can, you know, sell their commodity, you know, at a price that they feel like is fair, which the House Judiciary Committee, they're actually wanting to sue OPEC now for doing what they're doing. But you know, I think that's a joke, because it's like, you know, why would the U.S. think that it can sue another nation for not selling their resources at a discount? You know, so I'm actually throughout the past year, I can say adamantly, and I've said it over and over again, OPEC has been my best friend. I hate our current administration. Everything that they're doing actually hurts the oil and gas industry, but everything OPEC has been doing has made me money.
So one positive case for cartels.
Yeah, like I said, I would send them all Christmas cards and fruit basket if I could.
Okay. Our firefighter, he's got a question for you. Have you heard of or used the site openinsider.com, which he says is free?
Yeah, I've never heard of it.
Okay, yeah, it's openinsider.com. Okay.
I mean, I will say that when it comes to financial, you kind of get what you pay for, is what I've noticed. So over the past year, I've actually been paying for more and more services, because the information that I get from those services has been well worth the fees. But you know, it kind of also comes down to how much money you have in the market. I mean, I've actually managed to triple my retirement accounts with oil and gas investing, and the private money that I have, I've almost got a tenfold gain on since the crash of last year.
Wow.
So considering my returns, I've been more than happy to pay for information that helps me maximize those returns and trade with confidence. Because if I wouldn't have had strong conviction, I wouldn't have made any of those returns. I had strong conviction. I swung for the fences because I felt like I had the right amount of data. So YOLO, you know, it means you only live once. So when people do something that's incredibly risky, and a lot of people would say that what I did last year was incredibly risky because I put all of my money in one sector, you know, it might have seemed risky, but it was all based off of what I knew of fundamentals within the market, what I knew about how much the world needed oil and gas. You know, what I knew about the sustainability of prices and OPEC needing higher dollars, and the fact that we might be in a multi-year supply squeeze because of the lack of capital spending since 2015.
Right. Yeah, it makes a lot of sense. So does anybody have any other questions for Christine? So it looks like you've done an excellent job answering all these questions. Nobody has anything more to ask.
Yeah,
So
well,
thank you very much
fun.
for giving your presentation. It was very informative.
Yeah, and like I said, it's actually a little bit of work to put together a presentation, but I would encourage people to do it. because it actually will test your investment thesis a little bit. When you have to defend what you're doing, you know, I mean, it's a good thing, you know, it's a good thing. So.
Yes. Oh, I just want to remind everybody, just comment came in. You are able right this minute to download Christine's presentation. If you look on your GoToWebinar window, there should be an icon of a page with the right-hand corner dog-eared. And if you click on that, you will be able to download a PDF of Christine's presentation today. Let's see. Oh, we got another question. Someone has asked, I don't quite understand it. He asked, do you share any of the info you get on FinTel on your broadcast? I guess on your stock.
I will sometimes say, hey, you know, I just noticed so and so, like I might say, hey, I just noticed that BlackRock increased their stake in a company that I own. Like if I see something meaningful, I will normally tag the stock and I will put that data. And a lot of the charts that I've shared in this presentation, everything has actually come off of charts that were shared or that I shared on StockTwits or Twitter, or I got from the EIA website, or I got from the Primary Vision website. So, I mean, you know, if you want to be heavily invested in the space and you kind of want to piggyback on other people's due diligence, you know, I would say that if you know how to use those resources, they can be incredibly valuable. I mean, if you, like I said, if you identify the right people to follow, you know, you can make a lot of money off their leads.
Right.
You know?
Yeah. These.
But, you know,
we appreciate these tips because it's almost like priming the pump to get you started, because there's so much information out there. It's hard to weed out the wheat from the chaff, so to say. And
yeah, and like
I also like to say that, you know, when you start trying to find good information on the internet, it's almost as though you have to put on a hazmat suit because there's so much garbage out there.
Yeah, but it's like also if there's been a major shock, like for instance, Laredo Petroleum, 2 days ago they reported and the stock went down 20%. And when they reported, I couldn't identify a reason that stock should have tanked the way it did. So I actually took a swing position in Laredo Petroleum, and I'm waiting for the stink to wear off. Because normally when there's been a major price shock, like a lot of people, when the price goes down, you know, they don't understand their investment. It's emotionally traded. Maybe it triggers some stop orders, and a lot of people get out. But 3 days later, the fear wears off, and the stock normally goes back up again. So I've positioned in Laredo for an easy rebound. So, you know, and you know, again, it's like on StockTwits, like I even announced, you know, like, I mean, I'm like, hey, Laredo's down 20%. I don't see any reason for it to have pulled back 20%. I'm taking a position for a swing trade, you know. And then there's other people that are on StockTwits and they're in that stock and they're like, oh no, this thing's way undervalued. It's going to be twice as much by the end of the year, and you know, and I'm like, well, you know, I'll evaluate whether I want to stay put in another month or two, you know, or whenever it gets back to where I think it's going to go. So, but you know, but like sometimes when there's a shock on something and you don't know what's happened, you can kind of go to into Twitter or StockTwits, and there's usually someone there that can say why. You know, why did the like, for instance, natural gas companies. So a couple of days ago, all the oil companies were going up and pretty much all the natural gas companies were flat. And, you know, and people are like, what's going on? You know, how come this company isn't doing well? today. And I'm like, well, that's because the price of natural gas is down today. You know, I'm like, you know, and then they're like, oh yeah, we forgot to look at that. And actually there is a freak winter storm occurring right now in Germany. They're actually getting snow. And if I had to bet money, I would say that on Monday, natural gas companies are going to be higher because this snowstorm is going to increase the demand for natural gas.
Okay, wow. Thank you so much. And I want to remind everybody, I will post these slides on our website for everyone. And which also I'm asking, please volunteer. We've got people who have continued to help out, and they're being worn out. We need new volunteers. So, okay, Christine, thank you very much. Have a wonderful weekend. Frank, thank you very much for your presentation. And if nobody else has any questions, I guess